Hi Team Value, JJ here. Welcome back. Well, is it possible to beat the stock market, that's the S&P 500 index benchmark, by doing nothing or almost nothing? How is this possible? We're going to look at an article today that did a back test and experiment to see that this could be the case. Okay, let's get into this. This article is from Morningstar and it's from a year ago. I was reminded of it this morning by our friend Bill Brewster from the Business Brew podcast. Good podcast if you haven't heard that before. And it's about what beat the S&P 500 over the past 3 decades. Doing nothing. The S&P 500 is, of course, the market benchmark for fund managers and investors because it's really hard to beat. What do they mean by doing nothing? Let's get into it and find out. It says a strategy of buying a basket of stocks and leaving them untouched outperform the index, not to mention scores of active managers. So by another name, this is known as the coffee can approach. If you have know about that before or similar to the coffee can approach, it basically means buying stocks and holding them for a long time and doing nothing, putting them in a coffee can, an old coffee can where people used to keep items of value, put them under the bed or wherever in a kitchen cupboard and just not touch it. People used to have share certificates and just put them in a coffee can and just leave them and do nothing. So the article is written by Jeffrey Tack and he says, imagine if you bought a basket of stocks 10 years ago and then you didn't trade them, not even rebalance. You just let them sit. How would you have done? And he's done an experiment here to find out how that would happen. I try to answer that question, he says, and offer some thoughts on the lessons the simple experiment might impart. This was the test he used. He says, to conduct the experiment, I started by compiling the S&P 500's holdings as of March 31st, 2013. I then pulled each holding's monthly returns over the next decade using those 120 monthly returns. I was able to compound each holding value as if someone had left the portfolio alone, reinvesting any dividends. So he's back tested this basically to see how it would have done over that time. More than 100 of the do nothing portfolio's holdings didn't make it to the end of the period, most having been acquired at some point along the way. That's interesting. A lot of companies are acquired along the way if you do this. In those instances, I assume the acquisition proceeds sat in cash. I mean, that's a big assumption. Because if somebody was having a portfolio, an investor, and they got cash by something like that, they probably reinvest it. But he says, in other words, I gradually increased the portfolio's cash stake along the way to approximate the amount of timing of the acquisition proceeds that would have rolled in. So he's stacking cash there. If something got sold without you doing anything to the portfolio, if a company got sold and cash came back, then he just kept it in cash for that time period, So over some of these periods, if we look back from, say, 2009, the global financial crisis, 10 years, the interest rates are really low, so they wouldn't have been getting interest rates. They're very high of somebody doing that. Nevertheless, thus, by the end of the 10-year period, the final portfolio was a mix of the surviving stocks and cash that had built up. So the all-important findings, he says, the do-nothing portfolio held its own. It generated 12.2% annual return over the 10 years ended 31st of March 2023. So 12.2% annualized, finishing in a virtual dead heat with the actual S&P 500. This is a decent achievement when you consider that while the S&P 500 is a passive benchmark, it isn't a set and forget it index. The S&P Index Committee chooses which stocks to add to the index and which to jettison. So the S&P 500 does change quite a lot. We have talk about, stocks that are rising. Let's talk of Palantir going into the S&P 500 in the last few years. Tesla's gone into the S&P 500. So when that happens, something drops out. These stocks come in and go out of the S&P 500, which is one of the reasons it's very hard to beat because it is quite dynamic. It's a really good benchmark, and that's why Warren Buffett often says to people, if they can't analyze stocks, if they don't have the ability or they don't have the time or they don't want to do it, to invest in the S&P 500 because it's done very well over the years. Very hard to beat. But this guy's saying he's worked out a way that this do nothing, the coffee can approach, can beat the market, at least match the market or beat the market. Now, if you're getting value out of this Beat the Market episode so far, I'd really appreciate it if you manage to remember to smash that like button to help the algorithm to spread it to more people. Thanks. He says, moreover, because the do-nothing portfolio was less volatile along the way, its risk-adjusted returns surpassed the actual S&P 500. It's something like 90% of funds don't beat the S&P 500. Fund managers, that is, don't beat the S&P 500. So professional fund managers, find it hard to. They've got fees as well, so people have to pay the fees. So net of fees, the vast majority don't beat the S&P 500. Now, as he points out, this showing is surprising for a few reasons. First, the do-nothing portfolio was hauling around more cash than the index was over the span because of the portfolio's policy of holding the proceeds from acquisitions in cash. So yes, holding all that cash in the time of low interest rates. I don't know if he took the interest rates into account or not. It finished the 10-year period at around 5.5% of assets in dry powder, meaning cash, whereas the actual S&P 500 was nearly fully invested throughout. Cash would have dragged on returns as markets rose, but the do-nothing portfolio's holdings were more than equal to the task. I mean, this is really surprising, that there was cash hanging around there and, not really doing anything, but it still did well against the S&P 500. Second, the do-nothing portfolio did, nothing. Stocks weren't added to or subtracted from the portfolio. This do-nothing approach is kind of a value investing approach. Warren Buffett, who has really accumulated companies, I say stocks, but really accumulated companies, Berkshire Hathaway, buys companies, they buy stocks of companies, and they really have kept them for a very long time, low turnover. So, really it's just as a conglomerate, Berkshire Hathaway is just a giant coffee can taking in stocks. It is actively managed, of course, but if they find a quality company, they're going to hold it for a very long time. Excuse me, just pausing to have a tasty beverage from my AeroPress coffee press, which I highly recommend. Full transparency though, I do own stock in the company that owns AeroPress, which is Tiny Limited. I've made videos about that before, but I wouldn't recommend a product that I didn't love. So I'll leave a link in the description to the Amazon shop if you want to check that out. AeroPress coffee press. Okay, so that's 1 decade. What about a greater period of time? Because you could get lucky within a 10-year period, if it was a good run. What about for a longer period? So he did expand the scope here, and he says, given these surprising findings, I ran the exact same exercise for 2 other overlapping periods, the 10 years ending 31st of March 2013, as well as the 10 years ended 31st of March 2003. I created do-nothing portfolios and then measured their subsequent returns. And guess what happened? Here's what the 10-year period ended 31st of March 2013 looked like. And as we can see from the chart there, the graph, that it did well again. He says, as with the 10 years ended 31st of March 2023, the do-nothing portfolio also held its own over the preceding decade, nearly matching the actual S&P 500's return. And once again, things looked even better on a risk-adjusted basis. You can see the table there. The do-nothing portfolio returned 8.32%, the S&P 500 8.53%. And he says, remarkably, the same also held true for the 10-year period ended 31st of March 2003. In fact, the do-nothing portfolio did best over that decade, topping the S&P 500 by nearly 1 percentage point a year. So it did much better, and you can see here through to March 2003, and that of course covers the tech bubble there. You can see 1998 to 1999 to 2000, around there was the tech bubble, and over that period, especially after 2000 as the tech bubble burst, this portfolio did well. So active investors would have got really excited about the bubble and bought into it. And active fund managers would have done that too. A lot of fund managers got pulled into the FOMO there. So it's in a way not surprising that this portfolio did quite well, just doing nothing over that period, not getting tempted by the market and the bubble situations. I mean, the same happened in late 2020 and 2021. People really got FOMO about their emerging tech stocks, but perhaps if people had a do-nothing portfolio, if they bought stocks well before that and just did nothing over that period, not looked at the market, they probably would have done better over that period. And Warren Buffett has implied this too. He said he'd be happy with the market if it closed for 10 years. If you bought a stock and then the stock market closed for 10 years, And then you're just going on not the voting machine of the market, but the weighing machine of the market over that 10 years, weighing the company's fundamentals. That is a better way to go. And that's similar to what's happening here, just buying stocks and holding them. So the do nothing portfolio was a 9.4% here return, and the S&P 500 is 8.53. So, significantly beating the market there. That's not to be sneezed at. A lot of people think that they can beat the market easily, but it's actually hard to do over the long term. So this portfolio did well. And so the upshot here is he says that the whole portfolio over the 30-year period will have done well, slightly higher return than the S&P 500 with less volatility. Now there's a lot more to this article, but we're going to skip down to the lessons here because we've got the gist of it. You can read the article, it's still online. But here are the lessons that he takes from this. Number one, don't insist on being fully invested at all times. A little extra cash gradually amassed can cushion the blows and is available to deploy as needed at the end of a long time horizon. It also can nicely complement a strategy of letting winners run, as it acts as a counterweight to the additional concentration at the top of the portfolio. So I think that's important, letting the winners run. I think for me, this is one of the main lessons here. If you've got winners in the portfolio, a lot of people take profits, even if it's a few 100%. And this is a lesson also from 100 Baggers, Chris Mayer's book, 100 Baggers. When people will sell out when it's 200, 300, 400%. If you really do want a 100 bagger, you've got to leave it in there for 20 years. It's often 20, 25 years to get a 100 bagger, and people sell out, or it can go down. You have to withstand these drops of 80%, 90%, as Amazon went through after the dot-com bubble, and other companies have too. So not looking at the market is one of the best ways to do that, of course, is just to buy it, set and forget, and letting the winners run. So number two, avoid equating success with particular buy and sell decisions. The do nothing portfolio didn't rush to replace one delisted stock with a new kid on the block. It let the cash build, biding its time. In general, fewer decisions we have to make, the better. And this seemed to hold true for even seemingly mundane choices like whether to continue holding 500 stocks in the portfolio or make do with fewer. So this is a lot of stocks to have. That would be a lot of stocks to have 500, and that's like holding the index. I would find it really hard to have cash sitting around for that long. If it was a 10-year stretch, you could say that you put money into another stock instead of having cash there. But as long as you held that for a long time, I think that would be similar, as long as you didn't chop and change all the time and trade. If you got some cash and then you redeployed it into the market and just left it there in the coffee can approach again, I say that would probably work too, rather than having cash build up like he's suggesting here. Number three, acknowledge the power of letting winners run. I think this is probably the most important lesson here. No doubt this won't suit everyone, in particular those who feel squeamish about having a big share of their portfolio tied up in a handful of names, but the do nothing portfolio owed at least some of its success to leaving its biggest gainers alone, notwithstanding conventional notions of risk management. So I think this is an important lesson, because some of the best investors of all time have done this, having reasonably concentrated portfolio but letting them run. If you look at Chuck Akra's portfolio over the last few decades, it's like a museum of multi-baggers that he's bought at good prices, and they're good quality companies with a long runway for growth, like American Tower is one of his 100 baggers. Berkshire Hathaway is another 100 bagger. He's got MasterCard, Visa, these companies that he's just let run for a very long time and has done very well. And not many, not a huge amount. And notably, he doesn't even have those Mag 7 stocks, which are popular right now, have done very well. He didn't really have any of those. I made a video about his portfolio before. I'll leave a link in the description to that if you want to check that out. But that is the idea of letting the winners run for a very long time. And lastly, leave intuition at the door. The responsible voice in our heads tells us that a strategy of doing nothing can't possibly work, yet markets repeatedly upend our expectations, which we often form by attempting to decode recent events and their future implications. Patience and humility beat action and good intentions. So I think there is a lot to be taken out of this coffee can approach. I mean, I try and do this. It's easy in times of volatility and market stress, or even it's more fun to research new stocks and to replace other ones that we already have. I wonder how many people have gone for a long time and then looked back at what they've sold and thought, oh, I wish I hadn't sold that because it's done well. Or even sold it 100%, 150% and looked back and it's, been a 10 bagger over time. I wonder how much that actually happens. So that's the idea here, to let the winners run, find good companies, and it can take a long time to do that. There really aren't many, and sticking with it over the long term. I'm not suggesting to use this strategy in particular, but there's definitely lessons to be learned here, I think. For me, the thing that I take about is let the winners run. Let them run and run, especially if they are smaller caps, because they could have a long runway for growth. With the mega caps that are over $1 trillion, not sure how big they can actually grow, but some of them have been surprising. Microsoft in particular has been surprising how well it's doing over time, and Google, those companies, how well I've been doing over time. But in general, I like to look for smaller caps with a long runway for growth, quality companies, and I'm planning to hold them for a long time. I've found some, but I'd like to find more. The goal would be to find, say, 10 of these companies, high quality compounders that are smaller caps that can run for a very long time. The other lesson here is not to be in a hurry. There's no hurry. So I'd love to know what you think of this do nothing approach, this coffee can approach of just holding companies for a very long time. I know it's very hard to do. Do you advocate this, or are you more of a trader, or are you rebalancing and then going into other ones? I know some people, they don't have a percentage that they go over. If it goes over 10%, they'll rebalance some. What's your strategy? Is it similar to this? Do you think this is a good idea? Let me know in the comments. Now I have some exciting news about the Art of Value Patreon. I've started a value supporter tier for just $1.50 US a month. Now this is primarily, as you can see here, for being a kind supporter of the Art of Value. So if you like the content I'm producing, you can support it with just $1.50 a month. And also you get some bonus content regularly there too for that tier. I do make a summary video, candid thoughts every week, and the value supporter will be included. There'll be some of that content. This is the Art of Value Patreon. There's a growing library of content on here, including this new weekly investing update for the value supporter tier. I made a 10.5-minute video there. It does include all the videos you see on other platforms. So this is the weekly update. Before that, I usually make a 20 to 30-minute video, and the supporter tier will get some of that candid thoughts about the investing for the week, things that I don't share anywhere else. Again, link in the description if you're interested in that. Alright, if you're watching this video on YouTube, I'm going to put a link here to what YouTube thinks that you in particular should watch next. So go and see that now if you want to. And thanks to everybody for watching or listening, whatever platform you're doing that on, and I'll see you in the next one.